Corporate taxation can be a murky world, and scandals are aplenty. Many a multi-million or billion-euro multinationals such as Starbucks, Google and Facebook have been caught using tax loopholes to fiddle the system, whilst generating vast profits. In Brussels, the European Commission estimates that member states lose between 50 to 70 billion euros a year in lost tax revenues. But that revenue still stands at 2.5% of GDP, the same as in the US. The only difference is that the EU tax average rate sits at around 25%, whereas across the pond it's closer to 39%. For financial experts, there's definitely a forum for regulating finance.
States within the G20 compete with each other. It's the case on tax, but it's also the case on financial regulation. We see now people in the US saying, Trump is clearly going forward with a financial deregulation agenda, very aggressive, and the financial lobby in Brussels is asking the Commission to follow.
The G20 brings together 2/3 of the global population and more than 4/5 of global GDP. And ahead of their latest gathering, calls are being made for greater regulation of the global financial system, especially in the wake of the Panama Papers and, of course, there was its predecessor, the LuxLeaks scandal.
If a country decides to become a safe harbor for tax reasons, it means less tax received for the countries. So there is a balance to be found between globalization, harmonization of tax measures, and the fact that some countries want to keep a competitive advantage. But basically the world needs more transparency.
Ahead of Hamburg, Angela Merkel has talked up the idea of a connected world, and part of that is addressing harmful tax practices. But whether G20 countries that favour low tax rates to drive up investment and revenues will be ready to play ball is another question. Mariam Zaidi, CGTN, Brussels.